beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang Seng down 0.7%. The Taiwanese index is down almost 2%.
Iran's key nuclear enrichment facilities have been completely and totally obliterated.
Markets are worried, but are they panicking? Are they throwing a tantrum? Absolutely not. 24,980 on the Nifty, about 0.5% lower.
According to market, all this is not going to have any material or lasting impact.
Some of that money is beginning to move back into US and, frankly, international markets.
Nifty and Sensex both under pressure.
Today, large part of the proceeds of QIP will be used to give exits to these investors.
The Nifty has claimed the 25,000 mark and in fact is trading, only 70 points lower.
Well, that's the day so far. It has been actually a pretty decent session all told. Markets are not down that much. Actually, they're off quite a bit from the lows of the session. That's going to be, the broad tone tenor of the conversation we'll have over the next hour or so as we track market closing. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Survi. Guys, afternoon.
Hi, good afternoon. Folks, the markets are speaking, and they're speaking loudly, are they not?
Yep.
Equities, US futures are positive. Oil, which spiked to 79 when trade opened out, on Monday morning, has come down to about 76. Dollar virtually unchanged. I think there's a lot that markets are saying.
Well, that's right. I think the last few days they were waiting for, whether or not the United States is going to get involved. Now they've gone ahead, got involved. So it's at least that part of the uncertainty seems to be behind. Hopefully there'll be some kind of de-escalation, which we're yet to hear about. But I think what's telling you about the pulse of the market is the mid-cap index. In the first hour itself, it moved into the green. And now you have the number of stocks advancing at 1,200 from around 400 earlier today. So the mid-cap index, as well as the crisscross lines come up for you in the screen. Yep. That's telling you that domestic money believes that this is going to be, short-lived with regard to the escalation.
Absolutely. And, in the morning we were saying how if the response is weak, oil prices perhaps have a lot to fall. They've not fallen a lot, but they're in the negative now.
Yeah.
So actually, Brent prices, I think we get those rates. Look at that. That's down about 0.25%. This a day after the US has struck Iran, right? In terms of those nuclear bases and nuclear sites, essentially, where uranium was being enriched, apparently. So this is quite symbolic in that sense. It's quite telling, as I was saying in the morning as well. What happens now? Will Iran respond for the... they've got to save face. They've got to do something. The question is what? And the way... I would look at it is, and you'll see, hear headlines and markets will respond. But broadly, if the response is very targeted, almost symbolic, tit for tat, almost like choreographed, the market will look through it and then maybe you get a bump and that gets faded. On the other hand, which is, I think, very, very unlikely, you get a widespread sort of, strike across, trying to target American stations and vessels and, bases around the region. Of course, then all bets are off. But I don't think that is the base case, or should be the base case at all. Some escalation, targeted perhaps, but the market should be able to look through it. We'll see. In the real world, anything can happen. It's not as if anything is foretold, but what we can do at best, of course, is just look at what's happening and just sort of try and read the tea leaves. So oil prices turn negative, gold prices struggling to sort of maintain their rally, just trading below Friday's close, focused on how Iran will sort of respond. And as far as the market is concerned, if you want to look at the level, 24,865 was a 20-day moving average, and we've kind of hit that in the morning. We bounced off it. We're still down about 0.5% or so. We'll see if there is more recovery afoot. Broader markets, as Nigel pointed out, also looking much, much better. Surabhi.
Absolutely. And I guess on geopolitics, perhaps the market also thinks it's a very different warfare, right? It's unlike Iraq. It's not a ground invasion. Yeah. These are aerial strikes, so the market believes that expecting any kind of a major military strike by Iran, out on US soil, it seems, at least from the market perspective, seems something extremely far-fetched at this point in time. Now let's talk about mid-caps. Like Nigel was saying, mid-caps are a nice bright shade of green. The index itself is up 0.5%, the mid-cap index. I'll just give some examples. Stocks are moving to news, to sentiment, to, individual price action. Polycap, for instance, reacting very well to a Jefferies note. Stocks up 5%. Some of the defense names have been up since morning. So, for instance, Garden Reach Shipbuilders, something like a Zen Technologies. Zentech is up 5%. Garden Reach is up about 6% as well. Even beyond that, there's VIP. There is IdeaForge also, another defense name, 10% up on IdeaForge as well. KEI Industries, so some of the wire and cable guys are looking good this afternoon. All around MRPL, look at MRPL, 8% up on MRPL. So plenty of names in the broader market which have been looking good.
Yeah, that's right. Just since you spoke about MRPL, even CPCL, Chennai Petro, that as well is up close to around 10%. And I was just doing some quick research on the company. The GRMs have moved up actually, which is good. That's helping them. Their fuel, their fuel and loss, that quotient has come down. So operating efficiency for them has improved as well. And also if you look at replacement cost of these assets and, compare it to the current EV, there appears to be some valuation comfort as well. You can get whipsawed on either side, but this big improvement in GRMs as well as their focus on reducing the operating losses explains why a couple of these names are doing very, very well, in today's trading session.
Okay, all right. That's a helpful perspective on some of these oil and gas names that are up and about. So let's get started then with the trading ideas. As always, we have Mitesh joining in. Mitesh, very interesting market. Bulls seem to be having the upper hand. What would you do in the last hour?
Good afternoon, sir. I'm still not sure, if there is a directional bias. In fact, morning I was calling for the markets to take support around 24,900. We went slightly lower than that. But then again, the idea was that most of the volatility indicators are still flat, so I was not expecting a large move, though I think the decline was slightly 70, 80 points more than what I expected. But I still believe that we are in a sideways consolidation. 24,850, 25,200 remains the range. So not much on the index, to be very honest. But yes, a couple of stocks looking interesting. Grasim and Opera Realty, I think, look good. Grasim is breaking out. Keep a stop below 2,700. Look for targets of 2,820. While Opera Realty is also, trying to break out of a sideways activity. So buy here with the stop below 1920, 1915 and look for a target of in excess of 2,000.
Okay. All right. Got that. Thanks a lot for that, Mitesh. Well, let's get in Vamakshi then. She's here to focus on a couple of big movers today. Z Entertainment, that one is flying away. Vama, tell us more.
Well, Nigel, the stock is flying away because the company reported a presentation yesterday, and in that presentation, they've highlighted some of the key focus areas for FY26. One of them being that they plan to achieve break-even in Z5 as compared to an EBITDA loss of almost 550 odd crores that they had reported in FY25. They also are focusing on execution of their business plan to achieve the targets that they had set out. Now, just to recap, back in Q4, they had outlined some targets, which includes a TV viewership share of almost 17.5%, ad revenue growth between 8 to 10%, EBITDA margin between 18 to 20%, and value unlocking in music as well as syndication. Now, they've also highlighted that market consolidation is leading to increased competition, and to counter that, they are also increasing their cash reserves as well as cash balances. Now, keep in mind that as of March end, their balance, their cash balance stood at 2,406 crores, and apart from that, very recently we did see the board approve issuance of fully convertible warrants to promoters worth 2,237 crores, and they also have an enabling resolution to raise 2,000 crore via FCCBs, out of which only the first tranche of 200 crores has been withdrawn. Now, the purpose that they're doing this is to first, number one, is compete effectively with the competitor, which is the Reliance Disney JV. They will also be acting proactively to address any rapid market share shift. Now, they've also outlined some growth levers for them going forward. They're developing new business verticals. They're building new distribution business models as well to capture a lot of eyeballs, and they're also enhancing content offerings to address all sort of age groups. They're also eyeing inorganic expansion through acquisitions or strategic partnerships in very high growth verticals such as digital as well as music. So they've outlined a very ambitious plan, and resultantly the stock is higher, but it will all depend on whether or not the company is able to execute on this.
Okay, all right. Thanks a lot for that, Vamakshi. 10% higher and massive volumes as well. Deepan Mehta of Alexa Equities joins us on the show. Deepan, what's your take? Z is set for better times, or would you avoid it going by past history?
No, I think that there's certainly a turnaround happening at Z. First of all, good afternoon, Nigel. There certainly is a turnaround happening at Z, and the management is far more focused on the business operations rather than all the M&A activities. And I think that they seem to have got gradually seem to have got their act in order. They are focusing on TRPs, reducing the losses from the OTT channel, looking at strategic gains as they can make to retain and grow their market share. So typically, it's just running the company better, focusing on content, focusing on improving efficiencies, reducing costs, and all of that will eventually get reflected in better performance. So very positive on Z Entertainment. I was very negative on the stock when all the controversies were there around it, but now I think the view certainly has changed for the positive, and it's a reasonably priced stock as well. I think 18 times or so trading 12-month, and if they're able to curtail the losses from the OTT division, then there could be a good delta in the profit. So it's a stock to watch out for. And if you're a turnaround specialist, this is a classic one for you.
Got it. Okay. All right. So Z, you're sounding a little bit more optimistic, Deepan, on this name. What about on these other couple of stocks that we were just discussing, MRPL as well as CPCL, Chennai Petro? What's your? Do you have a view out there? GRMs have improved. As a percentage of the mix, I think CPCL has higher amount of diesel. And they've also focused on bringing down losses. I think the valuations as well are supportive for them. Any view on either of these two names, or is it too tricky to play?
Well, Nigel, they're typical commodity stocks. There's nothing really exciting in them. From time to time, you'll have a very powerful trading rally in them, depending upon improving fundamentals the refining ratios and other things. But end of the day, I think they haven't created much value over the last several years or so. And I'm generally not in favor of investing in commodity type businesses. So I would like to avoid them. But as I said, I think they are cheap, and some positive news flow can come through, can take the stock prices higher. So the good current traders can play it. But I think for a long-term investment perspective, it's an avoid.
Okay, I think, as someone was pointing out, while crude oil supplies have not been disrupted, refining capacity is another matter. Refining capacity maybe has been disrupted. We saw this with Russia, Ukraine as well. But of course, back then, oil prices also jumped substantially. But the tightness in refining capacity lingered for a lot lower, even after oil prices had come off. So essentially, product spreads is what matters when you look at refining. And there maybe there is, spreads are widened, etc. So we'll have to track that. Maybe we'll try and speak with these companies as we go on. Well, let's talk about the other sector, which is buzzing, defense. Now, Vamakshi is here with what's happening. Actually, there are lots of these, some small, but some larger companies as well, which are up 4, 5, 6%. Ria, tell us more.
Well, yes, defense stocks have surged once again today after the tensions between Israel and Iran have escalated as the US has joined in the war. The defense index today is up over 2%, and the biggest movers in terms of individual names include Apollo Micro, Idea Forge, Garden Reach, Zentech, BEML, and even Paris Defense. One clear trend that we're seeing is that there's been some increased interest in drone and UAV companies as well. Just quickly taking a look at some news flow over the weekend and today that is impacting individual stocks. The first one is Idea Forge hitting an upper circuit of 10% after the company has received orders worth rupees 137 crores to supply mini UAVs along with accessories to the Ministry of Defense. This is to be executed over a period of 1 year. And remember, the order book at the end of FY25 stood just at rupees 13.6 crores. So this is a very big order for the company. The next one is Zen Technologies, 5% upper circuit for this one as well. The company has announced the strategic acquisition of majority stake in TISA Aerospace, which specializes in the development of loitering munitions as well as UAVs. And this marks the company's entry into the UAV segment as far as the defense space is concerned. The last one is BEL. The stock is also up around 3% after securing orders cumulatively worth rupees 585 crores. And remember, the company had said that they're expecting to receive about rupees 27,000 crores of orders in FY26, X of the QRSAM order that they're also expecting to receive in this year as well. Apart from this, just taking a look at the value valuations in the overall defense pack. Only 2 out of the 15 stocks that we've looked at are trading at or below their respective 3-year average PEs, and these are Paras Defense and Mazgon Dock. In terms of prices, many stocks are still trading anywhere between 7 to 34% below their respective 52-week highs, and these include names like DCX Systems, Idea Forge, Cochin Shipyard, Zen Technologies, and MTAR Tech as well. And some names including GRSE, Solar Industries, BEL, and Apollo Micro are trading close to or above their respective 52-week highs.
Okay, that's an important valuation chart that comes up. Let's actually put that back up, that valuation chart, and we'll discuss this with Deepan. DCX System, obviously trading above the average PE. Idea Forge, obviously higher. Cochin Shipyard, way above the 3-year averages. And it's pretty much the same for all of the stocks out there. Very few will be trading at or below their average price to earnings multiples. Deepan, hi, good afternoon. That's the conundrum, right? What do? If you put the PE filter, you shouldn't be buying any defense stock. But then people say, look at order books, look at the environment, look at 10-year opportunity, look at PEG, so on and so forth. I mean, there are arguments on both sides. Where do you stand?
I think it's a simple strategy. If you're already invested in a few other stocks, then remain invested. Don't worry too much about the PE multiple because the stocks have rallied so much. You have margin of safety. You can absorb the volatility in earnings in the stock price. From a fresh investment perspective, you're better off buying when the stock is slightly out of favor or it is dormant, correction of 15-20% in the valuation, which could be lower stock prices or increase in earnings per share. But look, this buying defense stocks is a global phenomena. And across the board, whether it's Europe, US, defense companies are doing really well. And, if war is in the air, then defense stocks are the best way to play it. So I think it's a simple logic. But at these levels, I think it's better to just wait and watch. No point chasing a running train. I'm not sure the returns will be as great 6-12 months down the line. So wait and watch and buy at decline.
Okay, all right. Deepan, wanted your view on Trent. What a brilliant move that stock has given. Post that analysts meet that they had last week, we had highlighted the stock, I think, around 5,700. Today, it's the biggest gainer on the Nifty. It's nearly at around 6,300. What's your view out here? Not a particularly cheap stock, but the vision that they laid out in their analyst meet was quite encouraging.
And I will first a disclosure that we have shares of Trent Limited. But, at these valuations, what sort of a return you can expect? Because over time, the valuations can only remain steady or go down, which means the return that you can expect will be in line or slightly lower than the growth in the earnings per share. And base effect will come into play as it always does for a lot of these consumer stocks. We have seen it to the bluest of blue chip companies like, say, a DMart as well, which was having phenomenal growth, but now that has kind of tapered off. And something similar will eventually happen in Trent as well. So, I mean, again, the same logic as defense stocks. If you're invested, remain invested. Wouldn't worry too much about the P multiple because there's margin of safety. Your cost of acquisition is low. But from a fresh investment perspective, I think one should look for better ideas. And I think within the retail space, some of these specialty retail companies, I think they have been languishing, but now we've seen good quarterly numbers. Companies like Campus Activewear, Go Fashion, Ethos, Metro Shoes, Campus Activewear. So these are the companies I think which I think are more may give higher returns to investors than maybe a Trent at this point of time, but assuming at least a year holding period.
No, got that point taken, Deepan. Lots moving, by the way. Market breadth is still slightly negative. 1,500 stocks are down and about 1,300 stocks are higher. There's enough action with volumes on the upside as well, and actually not enough action on the downside with volumes. So that's the other thing to note. More volume on stocks which are higher and less volumes, even though numerically it's declines over advances at this point in time. Sterlite Tech made a high early last week. It's kind of sort of been drifting off. One-way move on Sterlite Tech recently. One source is down about 5.5%, 6% or so. That's actually very few names with any significant volumes on the downside. So that's something to keep an eye out on as well. Deepan, thank you very much for joining us. Good speaking with you. Appreciate it. We'll take a quick commercial break here. Lots more to talk about on the other side. Rupen Rajguru should be with us in just a bit. Okay, welcome back. Markets down 127 points and 24,986 is where we are now trading at. Rupen Rajguru is with us, Head of Equity Investments and Strategy at Julius Baer. Rupen, good to have you here. You know, we were just earlier talking about standalone refiners, but I think you do have a kind of positive value-led call on OMCs. Correct me if I'm wrong. Oil marketing companies. Any thoughts on this pack, Rupen?
Yeah, hi. Good afternoon, Prashant. So, see, OMCs typically are trading bet. So, probably 2-3 months back, we had a positive call on that. That was basis the lower oil price, wherein the oil price was hovering around 60, 65. So, in the current moment, while the oil price will be volatile, but if oil price were to revert down, which is what we believe it would eventually be. At that moment, definitely we would be constructive on that, because what we have seen, as I think you also rightly mentioned earlier, that the GRMs have firmed up. I think the key for all the OMCs are the marketing margins. The margins are were before the oil price hike was close to 10-11 bucks as compared to steady state marketing margin of $3 to $4. So there's definitely enough cushion. But while I think volatile oil price will keep these stocks under check, but yes, I would say watch out for if oil price were to come down, it will definitely have a positive impact on all the OMCs.
Mm-hmm. Hi, Rupen. Good afternoon. Good to see you, Ben. Well, the other pocket that you have liked, which actually hasn't performed too well, is insurance. But do you believe it's in for better times now, and valuations are as well are palatable?
Yes, hi, afternoon, Nigel. You are right. If you see insurance as a sector, while it has done well this year, but if you zoom out and see from last 3 to 4 year perspective, this sector has seen significant derating. And one of the primary reason for derating, apart from a little bit slowing earnings growth, was extremely tight a regulatory environment which had more and more news which were negative towards that sector, starting from the taxation front and some of the other areas which we have seen play out. And hence we have seen a significant derating of the sector. Today, if you see what we believe, incrementally the regulatory environment is easing. If you see across the board, starting from RBI or SEBI, while as we speak, we currently don't have we are awaiting for a new IRDA chief, and our strong sense is that overall the environment on the regulatory side would be a little bit loosening, which augurs well. And we have already seen some of those tightening measures like banca assurance channels and all. Now they have reversed on that. So A, the regulatory environment is now better. B, from a growth perspective, we believe growth is coming back. Protection as a business is doing well. And in an environment where the interest rates are low, and finally we are seeing banks also cutting their deposit rates. So some of those non-par products which had lost flavor because a lot of banks were garnering, focusing on deposits. Now the focus will come back on insurance products, which typically are non-par products, and that again growth will come there. So combination of all that plus lower valuation, we believe this sector can see both earnings growth and re-rating. And hence, yes, you're right, we are constructive on the insurance companies.
Okay, insurance is an area that you like. Rupen, hi, good afternoon. Just before you joined us, our colleague was appraising us once again of the defense names and the way the valuations are moving. And we were just discussing this, right? Because valuation-wise, most stocks are trading above historical, average PE multiples. But what is your sense? I mean, overall, the environment that we are in, if someone wants to take fresh exposure, first of all, is it advisable or is it already too late?
Yeah, hi, Surabhi. I think I agree with this conundrum. And in fact, if you see today, intuitively, markets are second-guessing a lot of things. So probably they are second-guessing all the bad news are temporary, because I think, as you rightly said, the oil is not moving up. Ideally, we all would have thought that oil will flare up today, but oil just marginally opened higher and now it is lower. Gold, which is supposed to also go up in an uncertain environment, is kind of steady and not moving up. But at the same time, defense stocks, because it's good news for them, they are moving up. So ideally, defense stocks also should not move up, right? Because on one hand, we are expecting that this war is not going to be lasting for long, and the sentimental impact on crude and gold is not seen, but the sentimental impact on defense is being seen. So yes, currently markets is only focusing that potential good news from a sector perspective, and on valuations, clearly all these stocks are trading way above our comfort level. So while we agree with the long-term potential which this sector would have, but we would definitely want to see translation of order books into revenues and into cash flows. And currently, the stock prices are discounting all that in a seamless execution for next 4 to 5 years. So ideally, we would want a meaningful correction in those stocks to come through for us to be constructive on that, and those segments.
Guys, some of these orders, I'm not sure, right? Smaller companies, I saw one order, 13 crores, 14 crore order. Stock is up 10%. I mean, maybe the market is saying, well, orders are coming at least, and this is from DRDO, etc. But some of these are, I mean, there is a strong element of the theme playing out rather than, maybe at the margin. Maybe that is the dominant driver, and stocks are just sort of, part of that theme which is working out. I'm not talking about the larger ones like BEL, etc., but some of the smaller ones which are now sort of, in a way, getting attached to the broader defense tailwind, which is lifting all boats. I mean, I think there's a fair bit of element. So, you need to be careful if you're looking to play a theme. I mean, you got to be in the right space. Stocks across the board, even if there is a whiff of defense, have done exceedingly well, very, very well. So keep that in mind, because otherwise you run the risk of getting stuck. Mood changes, things start to drop, and the exits become difficult, especially in some of the smaller names out there. I think we've got 130 odd points. Katamin market, of course, just not doing very much at all on the downside. Off the lows, though, I think that's the best way to kind of put it. NBFC is another area you still like, Rupen, from the financial space?
Sure. So, Prashant, in the current environment, one thing is very clear. The RBI, so to say, the bazooka which RBI has given the market by way of, not only rate cuts, but significant liquidity infusion. And now what we are seeing, the rate transmission is much faster. So typically in an environment, like this, the wholesale funded financiers, so which essentially would be NBFCs and some of the other players, tend to get benefited the most, because while their asset pricing will take some time to get repriced lower, but their liabilities gets repriced immediately, because the bank loans which they are taken will get lowered immediately. So there is a case for a NIM expansion. And historically, what we have seen in an environment of easy liquidity, lower inflation, and lower interest rates, typically NBFCs tend to do well, and the growth definitely would be much higher than the system growth rate. So from that perspective, we believe NBFC is in a sweet spot, and from our next 3 to 4 quarters perspective, we believe the numbers will be much better than the market expectation, and hence we are constructive on that side.
Okay, all right. Final question before we let you go, Rupen. I think you'd like some of these cement names as well. Some of them have come off a little bit because demand was a little softish in the first parts of the first quarter. However, the positive was that pricing has started improving. Are you still bullish on this theme? What do you like, large, mid caps, or any kind of geographic breakup you're looking at?
So, Nigel, you are right. Cement as a sector had one of the toughest years last year, and in fact, middle of last year, without any specific reason on either the pricing side, but they had seen the worst ever EBITDA margin, and thereafter, for last 2 quarters, we are seeing improvement. So, what we believe, 2-3 things. That this year, the overall industry growth rate, the volume growth rate would be much better than last year, which was sub 4-5%. This year, we believe it will be much higher. It will be closer to 7 to 8%. And as you rightly said, the key thing now is the pricing discipline is slowly coming back. Earlier, there was when the two groups were in loggerheads and there was a huge acquisition spree. There was a significant de-rating which we had seen for, barring the top two group stocks, or rather the top companies, the other companies had seen a significant de-rating. But now with the pricing environment coming back, some of those other top 3, top 4 players where we believe can see better days than what they have seen. And yes, from a pricing perspective, South has seen the maximum pricing impact positively, and the numbers of South-based cement companies will be much better in next 2 to 3 quarters. But from our pecking order, probably we would look into buying into the, say, number 3, number 4 players in the cement pack.
Okay. All right. Got that. Rupen, good talking to you today. Thank you very much for taking out the time and giving us the market perspective. By the way, there were some updates there that were there on the ticker as well. Just an update that there will be a meeting between the Russians and the Iranians today. And it seems that it is, Putin himself who will be receiving the Iranian foreign minister and then discussing the way forward. So let's see. The story may not entirely be dead. We'll figure out what the next couple of hours and days bring. Right now, a quick break. Come back on the other side. We'll get you a check on all the dealing room buzz. Nimesh will join in. And then some final trading calls with Nitesh.
Welcome back. You're tuned into Closing Bell, and we are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, the markets down 120 points, but a lot of action from the broader markets. Let's hop across to Nimesh, who's joining in on D Street Chatter to tell us what is he picking up. Nimesh, not a bad outcome at all.
Absolutely. Quite a bit of resilience for the Indian market, so to speak. And within that, I guess, is the broader markets, which are relatively outperforming. A lot of individual stocks are buzzing as well. But from a flow perspective, Nigel, again, it's a mixed day with a bit of a negative bias. So clearly, there is not big push from the large institutions as far as large cap Nifty names are concerned. Within sectors, the PSU banks and the oil marketing companies is where there's a bit of buying interest back from large institutions. So that stands out for me in today's market. Tech is down largely on back of Accenture numbers, and the general feedback was it was not a big positive read-through for the Indian IT companies. So that's dragging the indices to some extent. But broadly, it's the mid-cap index which is buzzing in trade, and flow seems to be a bit negative within the large institutions.
Nimesh, thanks very much for that. What about stocks? What are you picking up?
So in terms of individual names, Prashant, the first stock is Kerala Ayurveda. We don't normally talk about this stock. Small cap company, 600 crore market cap, but the stock is locked at 20% upper circuit after a very large block. Nearly 20% equity got changed hands. I understand the promoter entity were sellers and a couple of influential HN investors were buyers in today's block deal. Apart from that, there is a sense of some corporate development as well, which is to follow after this block. So potential fundraising and some deals as well is what I understand in Kerala. So that's the reason why that stock is locked at 20% upper circuit today. The second stock is Marathon Next Gen Realty. Again, within the real estate names, this is one stock which is relatively outperformed today, up 7%. A couple of reasons for that. One, there was a selling pressure from a leading FII. That seems to be largely over. And also, I understand company is likely to raise funds via QIP very soon. So that's the trigger there. The third stock is Bandhan Bank. Within the small private banks, this is relatively outperformed of late, largely on back of FI buying. And I understand within that, a leading long-only FI has been an active buyer in Bandhan Bank in the last few days. And the last couple of stocks were this delivery-based buying, GMR Airports as well as JSW Energy. Both stands out after recent underperformance summit of buying has resumed in both these names. So watch out for delivery-based buying in these two names today.
Nimesh, on this Kerala Ayurveda, 600 crore market cap. I think Purinju is one of the shareholders I could see, owns about 5%. The last time, maybe the numbers have to be updated. But big move, I mean,
big move.
Ended 22 at 100 rupees, at 400 plus now.
Absolutely. And the fact that today there was a large block, 20% got changed hands. Some large HNI investors have bought as well. So looks like there is more on the cards. Not only today's block deal, but I understand there could be a pref issue where the companies will raise further money, and there could be some more developments as well. So it looks like there is something more than today's block deal in this particular stock.
Okay, all right. Thanks very much. We'll keep an eye, and as always, thanks very much for joining us on D Street Chatter with the Chatter stocks and the Chatter itself. Mitesh is with us with what to do in terms of near-term trades, sort of trades for tomorrow, I guess. Mitesh, what do you have? What should one do?
But on Polycab, something, which is got, I think the stock is still strong. Take a BTS to with the stock at 62.60 for damage. And the other one is Tata Consumer, which can be also position call, but we'll go for a BTST first. Take a BTST with the stock at level of 2 for damage.
Not very clear, Mitesh. We'll come back to you to get those levels out of the way, Polycab and Tata Consumer, I think. So we'll go back to Nimesh, to Mitesh and get those levels. But let's focus on Polycab. That's in focus. There's a positive note coming in from Jefferies. Upasana joins us to tell us their rationale behind that. Upasana?
Well, Jefferies has given a buy rating on the stock with a target price of 7,150 per share. It says that despite 25% uptick from March 2025 that we've seen, the stock still trades at a 4% higher than a historical 5-year average. Now, talking about the market share in FY25, the company gained 1% market share in organized cables and wire segment, which currently stands at around 26 to 27%, versus 80% market share that the company had seen in FY20. Now, it says that the company's timely capex, that is 2,800 crore in last 4 years, has aided 26% sales CAGR in cables and wire segment. Now, coming to their FMEG segment, which is nearly 10% of their sales, it turned profitable post 10 quarters for the first time. Now, company in its FY25 annual report has highlighted Project Spring and FY30 targets as well, which are aspiring is what the brokerage has indicated. Now, for FY25 to FY28 EPS CAGR, the brokerage is estimating around 26%, which will be driven by strong order book and even better FMEG margins. So overall, it's a positive note from Jefferies on Polycab.
Okay. All right. Got that. Thanks very much for that. And Polycab is one of the stocks that Mitesh had also liked. Mitesh, just clarifying once again, the levels that you mentioned on Polycab?
So Polycab, I think, is closing with a good strength near the day's high. See, again, I'm giving a BTST here because that's the format needed, but I think it's a good positional call. So for a BTST thing, take a stop just below levels of 60 to 80, look for a target of around 63.35, 63.40. It's also crosses 200 average. So for positional traders, take a stop just slightly deeper stop below 61.90 and look for a target in excess of around 67.50.
Okay. All right. Got it. Mitesh, thank you very much for that. You have a good rest of the day and we'll connect again tomorrow morning. Right now, let's go across to an exclusive story. Sources are telling CNBC-TV18 that BSE and Interglobe Aviation may enter the Nifty. Yash has more details on this. Yash, what are you picking up?
Well, that's correct, Surbhi. So, of course, two important stocks which will be in focus till the time the next Nifty review happens would be BSE and Interglobe Aviation or Indigo. What sources tell us is that both these stocks are likely candidates when it comes to getting included in the Nifty 50 index when the review happens next. As per our sources, the review is expected to happen in the month of August, which then will be effective the month of September. As far as the exclusions in place of the two inclusions, that is BSE and Indigo, are concerned, these two stocks could replace stocks like IndusInd Bank as well as Hero MotoCorp when it comes to the stocks that would be excluding Nifty 50. Now, the parameters on which these stocks are decided would be that the average free float market cap of these companies will have to be double of the current 49th and 50th stock in Nifty 50. That is IndusInd Bank and Hero MotoCorp. That is for the previous 6 months. And as we get closer to the date of the reject, the cutoff date would be announced from which the previous 6 months would be calculated as far as that average public float is for these two stocks is concerned. We've written to NSE on this particular query. A reply from them is still awaited.
Okay. All right, Yash, thanks very much for that. So let's watch out for future Nifty changes and whether these two make the cut. Let's move on now and address, of course, the big global international story, which is, of course, escalating tensions in West Asia. Israel and Iran have continued to strike each other through the course of the last few hours after the U.S. attacks on Iran's facilities. Now, Iran's air defense systems intercepted hostile targets over the capital of Tehran. Missiles were also seen in skies above Jerusalem, with sirens warning people to enter shelters. Over the weekend, of course, the United States bombed key nuclear facilities in Iran, and President Trump has said that the attacks were a spectacular military success, and he warned of more attacks if Tehran did not surrender. NBC's Richard Engel with the latest.
Just hours after those U.S. airstrikes on its nuclear facilities, Iran fired dozens of ballistic missiles at residential areas of Tel Aviv, hitting this apartment building, causing significant damage, although few injuries. People here warned to go to bomb shelters.
So we've just moved into our own safe room in the place where we're staying. You can still hear the air raid sirens, and there have been some very loud impacts close by.
Israel kept up its attacks inside Iran, taking out more missile launchers. Israel's prime minister, who has been pushing the U.S. to join an attack on Iran's nuclear sites for decades, today congratulating President Trump.
History will record that President Trump acted to deny the world's most dangerous regime the world's most dangerous weapons.
Many in Israel appeared to agree.
I want to thank President Trump because this could be the end of the war.
In Iran, there was anger in the streets. Iran's foreign minister today saying his country was in the midst of negotiations as the American bombs dropped.
There is no red line that they have not crossed. And the last one, and the most dangerous one, was happened only last night.
But will Iran attack the U.S. directly? Its missiles and fighter jets don't have the range to reach the United States. But American troops and bases in the Middle East could be targeted. Iran's parliament voted to close the Strait of Hormuz, a potential economic attack. 20% of the world's oil flows through the strait, but no action. Parliament saying the move would have to be approved by Iran's supreme leader. The New York Times reports, citing 3 Iranian officials, Ayatollah Ali Khamenei is now in a bunker and has picked replacements in case he's killed. Across the Middle East, the response from Arab countries was largely silent. Many calls for talks, no government offering to fight for Iran.
The only people in the world that are unhappy about what happened in Iran last night is the regime in Iran.
Okay, well, that's basically the update coming through. Let's focus on commodities now. Of course, as part of our new programming on CNBC-TV18 Prime, I spoke with Max Layton. He's the global head of commodities at Citi earlier today. He's got a very, very non-consensus view on gold, which is, of course, one of the safe havens. He thinks gold will not go up. The top is already in and prices could tumble 20% from current levels late this year and 2026 as well. So that is gold. The other bit is aluminum, where he thinks the story has just begun. Listen in.
The gold bull market, it's really accelerated this year. Start of this year, gold was trading around $2,700. End of last year, around $2,600. And we've rallied all the way to almost $3,400 at the moment. It's that part of the rally. It's this most recent part of the rally that we think in the base case by the second half of next year. So we're, in the near term, we're neutral on gold. In the near term, we see it consolidating at these phenomenally high prices by historical standards. But in 12, 18 months' time, it's really a combination of a number of factors. But the first is President Trump is incentivized to drive an improvement in US growth, both growth and sentiment, into the midterm elections towards the end of 2026. We think the Fed has been at quite restrictive levels of policy, and we think just the move to neutral will improve both US and global growth sentiment. And there is the prospect that geopolitically things are less heated than they are today, both in the Middle East, but also with respect to the trade situation. So as you look into the midterms, much of the stuff that President Trump has done, particularly around trade, has raised global growth concerns, has led to people to barbell their equity portfolios with being long gold. And at the margin, into the midterms, we do think there is a President Trump put on his popularity and on US growth specifically that will at least will come into play as we look into the midterms. And we think, the market starts at President Trump and the market starts to think about that towards the end of this year, early next year. And that's the reason why we have gold coming off a little bit towards the end of this year and into 2026. The aluminium outlook is structurally bullish. This is a commodity that is very power intensive. A lot of people talk about aluminium as being, power in the form of metal. So it's super power intensive. And I'm sure you've heard, and there's been a lot of talk about the likely boom in power demand coming from AI and data centers. So power demand is being, particularly green power, is going to be in short supply relative to demand from things like data centers and the build out of electric vehicle supply chains and increasing use of electricity globally. Aluminium's at the heart of all this, has essentially no supply growth on paper over the next 2 to 5 years. China drove supply growth for the last 20 years, and that's come to an end. The smelters, even if they wanted to, probably couldn't get access to green power because they're competing against things like the data centers. And guess what? Aluminium is used in the data centers. It's used It's an important part of things like humanoid robots, robot dogs in the robotics sector. And one day we think we are going to have an improvement in global growth sentiment. It's been pretty soft for 3 years now, but one day over the next 12 to 24 months, we do think there'll be a turn in global growth and turn in global manufacturing sentiment. Aluminium will be super leveraged to that. So yeah, we do see some very substantial upside in Ali.
Well, that is, slightly bearish on gold, but very, very bullish on aluminum. Remember to tune into the all-new CNBC TV18 Prime offering. And we're, of course, bringing you insights from policymakers, business leaders, economists, and, of course, we're talking about a wide range of subjects. So the shows that you can watch at 12 noon, you've got the Global Reset. At 1 o'clock, you've got the Big C. And at 8:30 in the evening, there is the Global Lens. So a completely new slew of programming lineup here on CNBC TV18 Prime. We'll take a quick commercial break here. See you on the other side with Sudeep Bandopadhyay of IndiTrade Capital.
Welcome back. Well, the markets, actually, the broader markets, there are a lot of stocks that are moving around. Case in point being, just pull up Supreme Petro. That one, in fact, has seen a sharp up move in the last few minutes. I think the intraday chart on that particular name should come up for you on the screen. Sharp uptick is what you're seeing out there. Sudeep Bandyopadhyay joins us on the show. Hi, Sudeep. Good afternoon. Good to see you, Ben. Any view on this name, Supreme Petro?
Well, we have been positive on this. I think, the last quarterly results also was pretty decent. There was a little bit of disappointment here and there, but by and large, we liked the results. I think, even valuation-wise, while it is not cheap, one can look at, getting into Supreme Petro even now from a long-term perspective.
Mm-hmm. Interesting. And I think, they had some inventory loss, I think so as well. And maybe in this quarter, we could see some part of that. But I think post that, the numbers should look up. Big move, massive volumes as well. Let's talk about a couple of these, delivery-based companies. Swiggy, Eternal. Do you like either of them?
Well, I do like Eternal. I think, one has to realize that the fact that you may not get a bumper quarterly number in the near future. And very clearly, they have articulated that. Eternal has articulated that they're going to spend on growing the quick commerce dark stores. And that does require quite a lot of investment. So immediate major upside may not be there. But from a long-term perspective, I think these are good businesses to be in. And if I have to pick one, I'll pick the leader because, some of these businesses, winner takes the all is what happens. So I will go with Zomato, or rather Eternal at this stage.
Go with Zomato, that is Eternal at this point in time. Sudeep, any thoughts on these, the KEIs of the world? You got, sharp move. Polycab is up very sharply.
Well, Prashant, I think, they had seen bad days when the bigger companies in the country announced their entry into cables and wire segment. They were beaten down mercilessly. And very clearly, the value-wise, they were looking attractive. I'm not saying they were cheap at any point in time, but they were definitely attractive because price had corrected significantly. Also, one has to remember that the competition here is not like paint industry that you decide to get into the business and you will be able to be in the business and start competing in the market within a period of 1.5 years. Here, it does take time, a lot of approvals, a lot of processes. While the competition will definitely come, but the way we look at it is that it will take time. B, market share will be lost by the unorganized sector more and more, not by really the entire organized sector. There was always a silver lining when the prices corrected, and to an extent, that is getting played out. Some of the research reports which came in highlighting some of these points were really helpful in pushing up the prices today.
Okay, all right. Sudeep, stay on. We'll just quickly get through the market close. Last 1.5 odd minutes of trade left. And it's a day that will go down with a cut of about 150 odd points. Market has recovered from the day's low. It's not been as bad as one would have imagined. And that's the situation with most global markets, actually. Not too many very deep cuts across Europe or Asia. So let's talk about the Nifty. Then what led to this 150-point drop? On the weak side, IT for sure, Infosys, HCL Tech, these names, TCS as well, Wipro, all of them down between 1 to 2.5%. Other big boys that were weak today included L&T, ITC, Lever. These stocks were down. The Bank Nifty today fell less than the Nifty. Nifty is closing down 0.6%. Bank Nifty is down about 0.4%. Some of the weak names include the likes of an SBI and an HDFC Bank. Even ICICI Bank is weak, no denying that. Some of the other names, Maruti, Reliance, all stocks losing over 0.5%. However, on the flip side, defense was definitely a theme. So the large space, BEL, in the stocks beyond the Nifty, you had names like Garden Reach, Shipbuilders, etc., Zen Tech, Idea Forge. All these defense names were up and about. Eternal